What are central bank reserve requirements in monetary policy? Have you ever wondered how banks manage the money you deposit? One key aspect is something called central bank reserve requirements. These are rules that tell banks how much money they need to keep on hand, known as reserves. These reserves can be cash in their vaults or money held in accounts at the central bank. The ratio of these reserves to the total deposits is known as the reserve requirement ratio or cash reserve ratio. The main goal of these requirements is to ensure banks have enough liquid assets to meet withdrawal requests. This helps maintain stability in the banking system. When central banks set higher reserve requirements, banks have to keep more money on hand. This means they can lend out less, which often leads to a decrease in the money supply and can push interest rates higher. On the flip side, if reserve requirements are lowered, banks can lend more money. This increases the money supply and can lead to lower interest rates. Historically, reserve requirements have played a significant role in monetary policy. For instance, during the 1960s and 1970s, the United States Federal Reserve actively used these requirements to manage the money supply and credit conditions. However, in recent years, many central banks have shifted their focus to other tools, like open market operations, and have changed reserve requirements less frequently. Reserve requirements can differ from one country to another and can even vary based on the size or type of bank. For example, since the year 2020, the United States has set its reserve requirements to 0. This means they're relying more on other methods to manage liquidity and credit. In contrast, countries like China, India, and Brazil still use reserve requirements more actively. Adjusting reserve requirements can also signal a central bank's approach to monetary policy. For example, if a central bank lowers reserve requirements during tough economic times, it can encourage lending and boost economic activity. Conversely, raising reserve requirements can help control inflation by limiting credit growth. From a historical perspective, reserve requirements illustrate how central banks balance the need for banking stability with the goal of controlling economic growth. Over time, their role has changed, reflecting shifts in banking systems and the development of new policy tools. Understanding these requirements gives us a clearer picture of how monetary policy has evolved and how it continues to shape our economy today.